Only 5 months ago, we were in a very hot seller's market across the Phoenix market. But as of November 14th, 2022, the Phoenix housing market has slid right into a buyer's market. There have been many headlines talking about the Phoenix housing market over the past few months, saying things like, Boise, Las Vegas, and Phoenix look like housing busts. Is a housing crash imminent? Here's how far home prices have dropped in the valley. Why experts say Arizona housing crisis is a growing cancer. Housing market warning as prices suddenly fall in one U.S. city. Guess what city they're talking about? Yep, Phoenix. The majority of the Phoenix market has been in a buyer's market for a while now, but the whole market has been propped up by the luxury sector. That has now ended, and the numbers have put the luxury market in a buyer's market. A mild buyer's market, but a buyer's market nonetheless. The prices in the Phoenix market have seen some dramatic increases over the past few years. And although I showed you that chart in the beginning of the video that was June, the peak of our market actually hit in May. And since then, we have seen our home price appreciation drop. One of the biggest reasons for this drop are our mortgage rates.
Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates.
As our mortgage rates increased, our demand just got weaker. At the same time this was happening, we saw iBuyers, short-term rental owners, and builders put their homes on the market into our inventory, which drastically increased our inventory. And this was the first time we started to have downward pressure on our pricing. Now, I've talked about this in some of my other videos. The number of homes that we have in the Phoenix market that were purchased by iBuyers not only drove up the prices, making homes unaffordable for first-time home buyers, but is now what our distressed seller looks like. And these sellers have only one option: to lower their prices. Does this mean we are headed for a repeat of 2008? So the short answer is no, but let's take a look at why. First off, we have to take a look at the loans that people were getting back then. Most of them were stated income, adjustable rate mortgages. The stated income mortgage is basically when someone goes into a lender and just tells them what they make without having to show any proof. Now, I don't know if any of you have gotten a loan in the past few years, but lending regulations are tight. This is not happening anymore. In fact, those predatory lending practices are no longer legal. You can actually see from this chart how lending practices have tightened up instead of going the other way. Getting a loan is tough right now. Now, I know some of you are hearing that as our interest rates have gone up, they're starting to introduce these adjustable rate mortgages again. But these are very different than the loans that they had back then. Back in 2006 to 2008, these adjustable rate mortgages were usually based on their stated income. On top of that, if you wanted to refinance out of these loans, they had huge prepayment penalties. So most would just stay in them. Today's adjustable rate mortgages don't have prepayment penalties. So you could potentially get an adjustable rate mortgage now so that your payments were lower. Then as interest rates come down, as long as you've got the equity in the home, refinance into a 30-year fixed payment. Now, I know some of you are already thinking, that's great, but what if home prices come down even farther and I don't have enough equity in my house? You're right. At that point, you would not be able to refinance. But that's why I say, make sure when you're looking at an adjustable rate mortgage, I wouldn't do it any shorter than 7 years. The other thing is, all of this that I've just said to you, check with your lender. I am not a lender. Make sure you run it by your lender. Some of these adjustable rate mortgages might have a prepayment penalty. Make sure you check out everything with your lender. Now, because of the buyer's market that we're in, before I did anything with an adjustable rate mortgage, I would see if I could get the seller to agree to seller concessions so that I could do a rate buy down. Now, there are 2-1 buy downs where the seller is buying down your rate for the first 2 years, or you can try to get a permanent buy down. Now, this will be more expensive, but it is the safer way to go. Now, just on a side note, if you try for the 2-1 buy down, you do have to qualify at the higher interest rate. Now, the other reason we are not headed in the same direction is all the equity that people have in their homes. Now, I know I have said that home price appreciation has come down, but you have to look at the overall appreciation, not just the appreciation from the last year, because 65% of the homes currently on the market have been owned more than 2 years. That means they've got at least 33% appreciation in their home, giving them quite a bit of equity. And for those that have owned their homes even longer, that's just more equity. The reality is that fewer sellers are choosing to sell in this market. Since the tipping point in June, accepted contracts have fallen and new listings have declined, which is why our market has glided into a buyer's market, not crashed. Historically, October adds about 10,000 new listings to our inventory, but this October was the lowest we've had on record with 7,334. This has caused our supply to stagnate over the last 4 weeks and is a small relief for sellers, putting a little bit less downward pressure on pricing. When we look at the Cromford Market Index, you can see where we are now at 89 versus where we were in 2007 at 26, which is the lowest historical weekly measure. This is where we're getting that glide. There has been a bit of positivity over the last few days when our mortgage rates actually dropped last Friday. Our new contract counts are up just a little bit, and we also have a slight increase in new listings. This isn't going to change the balance in our market. We are going to stay in this buyer's market, but it might help more homes go under contract, which would be welcomed by many. Buyers and sellers just don't like to participate in a market with so much uncertainty. Dramatic fluctuations in mortgage rates, insecurities around inflation and unemployment have pressed pause on people making decisions regarding housing. If mortgage rates drop, we will see buyers get off the fence, which is exactly what we saw in July when mortgage rates dropped to 5%. And many mortgage analysts are actually saying we will be back to 5% in early 2023, which could really change our demand. But for now, we are in a buyer's market. And in the fourth quarter of any year, whether it be a buyer's or a seller's market, it is the best time to buy. Sellers are wanting to get rid of these houses so that they don't have to deal with it in the new year. Just last year, I had a buyer that I finally got under contract in December after losing out to multiple offers multiple times on a few different homes. But in December, we were able to negotiate not only on price, but also repairs and get them a great deal because the market was in its normal seasonal slowdown. And then in January, everything shot off like a rocket. Now, I am not saying that is what's going to happen in 2023. But we will likely see our inventory increase just a little bit like normal, as well as our demand pick up just like normal. So while we are in this fourth quarter in a buyer's market, if you are ready to buy, I would strike while the iron's hot. And before you slam me in the comments telling me that no one should be buying right now, I don't disagree. This is not the right time for everyone to buy. This is for people that are going to be staying in their house for 7 years plus and can afford it. And when I say afford it, I mean they have saved money for their down payment. They are not stretching themselves. They have secure jobs. All of the things you need to have to be buying in a market like this right now. And for all of those people saying don't buy because we're timing the market, we'll buy when it hits the bottom. We will not know when we've hit the bottom for 3 to 4 months after we have already hit the bottom. And after that, you will have missed the bottom. You can't time the market. For now, there are deals to be had in this market. If you would like to find out where, take a look at this video right here. If I can answer any questions for you, please feel free to reach out. As always, I thank you for watching and I'll see you next time.